Imagine if a small group of people had the power to change the cost of money across the entire economy. Mortgages, credit cards, business loans, stock markets, all of them reacting to a single decision. A decision made inside one institution, the central bank. When central banks change interest rates, the effects spread through the entire financial system. They influence inflation, economic growth, investment markets, and even the cost of everyday life. But how exactly do central banks control interest rates? And more importantly, how do those decisions affect your money? To understand that, we first need to understand why interest rates are so powerful in the first place. Why interest rates matter. Interest rates represent the cost of borrowing money. When interest rates are low, borrowing becomes cheap. People take mortgages. Businesses take loans. Investments increase. Economic activity usually accelerates. But when interest rates rise, borrowing becomes more expensive. Consumers slow down spending. Businesses postpone investments. Economic growth can slow. Because of this, interest rates influence nearly every financial decision in the economy. And that is why central banks use interest rates as one of their main tools to guide economic stability. What a central bank actually is. A central bank is the institution responsible for managing a country's monetary system. Examples include the Federal Reserve in the United States, the European Central Bank in Europe, and the Bank of England in the United Kingdom. Central banks do not operate like regular commercial banks. They do not offer checking accounts or consumer loans. Instead, they supervise the banking system and control monetary policy. Their main objectives usually include maintaining price stability, controlling inflation, and supporting economic stability. And the most powerful tool they use to achieve these goals is the control of interest rates. How central banks control interest rates. Central banks influence interest rates primarily through what is known as the policy interest rate. This rate affects how commercial banks borrow money from the central bank. When the central bank raises its policy rate, borrowing money becomes more expensive for commercial banks. Commercial banks then pass those higher costs to consumers and businesses through higher loan rates. Mortgages become more expensive. Credit card interest rises. Business loans become harder to afford. When the central bank lowers its policy rate, the opposite happens. Borrowing becomes cheaper, encouraging spending and investment. Through this mechanism, central banks influence the overall cost of money throughout the economy. Tools. Central banks. USE. Central banks have several tools to influence interest rates and liquidity in the financial system. One of the main tools is open market operations, where the central bank buys or sells government bonds in financial markets. When central banks buy bonds, they inject money into the banking system, increasing liquidity. When they sell bonds, they remove money from the system, tightening financial conditions. Another important tool is reserve requirements, which determine how much money commercial banks must hold in reserves. Central banks can also provide emergency lending to stabilize the banking system during financial stress. These mechanisms allow central banks to influence financial conditions across the entire economy. How interest rates affect inflation. One of the primary reasons central banks adjust interest rates is to control inflation. When inflation rises too quickly, central banks often raise interest rates. Higher rates reduce borrowing and spending. As demand slows, price pressures may begin to stabilize. When inflation falls too low, central banks may reduce interest rates to stimulate economic activity. Lower borrowing costs encourage spending, investment, and economic expansion. This balance between interest rates and inflation is one of the central challenges of monetary policy. How interest rates affect borrowing changes, and interest rates directly affect how people borrow money. When interest rates rise, monthly payments on loans become higher. Mortgage payments increase. Credit card interest becomes more expensive. Car loans become harder to afford. As borrowing becomes more expensive, consumers often reduce spending. Businesses may delay expansion plans or investment projects. This slowdown in borrowing activity can ripple across the economy. Impact on businesses and jobs. Businesses are highly sensitive to interest rates. When borrowing costs are low, companies are more likely to invest in expansion. They may build new facilities, hire workers, and increase production. But when interest rates rise significantly, borrowing becomes more expensive. Investment slows. Some businesses reduce hiring. In extreme cases, economic slowdowns can even lead to layoffs. This is why central bank decisions can influence employment levels across an entire country. Impact on investment markets. Interest rates also have a powerful impact on financial markets. When interest rates are low, investors often search for higher returns in stocks and other assets. This can push stock markets higher. But when interest rates rise, safer investments like government bonds may become more attractive. Higher interest rates can also reduce corporate profits by increasing borrowing costs for companies. As a result, stock markets often react strongly to changes in interest rate policy. Why central banks raise or cut rates? Central banks constantly analyze economic data when deciding whether to raise or lower interest rates. They monitor inflation trends, employment levels, economic growth, and financial stability. If inflation rises too quickly, they may raise rates to slow the economy. If economic growth weakens, they may lower rates to stimulate activity. These decisions involve balancing complex economic forces, and even small changes in interest rates can produce large ripple effects throughout the financial system. When rates go too high, if interest rates rise too aggressively, economic activity can slow too much. Consumers reduce spending, businesses cut investment, housing markets may cool. In extreme cases, high interest rates can contribute to economic recessions. Because of this risk, central banks must carefully balance the pace and size of rate increases. When rates stay too low, on the other hand, keeping interest rates too low for too long can also create problems. Cheap borrowing can encourage excessive risk. Asset bubbles may form in stock markets or real estate. Debt levels across households and corporations may grow too quickly. If those bubbles eventually burst, the financial system can face serious instability. How this affects your money. Central bank decisions influence many aspects of your financial life. They affect mortgage rates, they influence credit card interest, they impact job markets, investment returns, and even the price of everyday goods. When interest rates change, the ripple effects spread through the entire economy. Even if most people never follow central bank meetings, those decisions still affect their financial future. How central bank decisions spread through the economy when central banks change interest rates. The effects do not appear instantly. Instead, they spread slowly through the financial system. First, commercial banks adjust their lending rates. Mortgage rates begin to move. Credit card interest changes. Business loans become more expensive or cheaper. As those borrowing conditions change, consumer behavior begins to change as well. If borrowing becomes more expensive, many households postpone large purchases. Buying a house may become less affordable. Financing a new car may become more difficult. Businesses also react to these changes. When borrowing costs rise, companies often become more cautious with investments. Expansion projects may be delayed. Hiring decisions may slow. Over time, these changes ripple across the economy, influencing growth, employment, and inflation. This process is known as the monetary transmission mechanism. And although it may take months or even years for the full effects to appear, central bank decisions eventually influence nearly every sector of the economy. Why markets react so strongly? Financial markets pay extremely close attention to central bank decisions. Even small changes in interest rate expectations can cause major movements in stock markets, bond markets, and currencies. Investors constantly try to anticipate what central banks will do next. If investors expect interest rates to rise, stock markets may fall. If investors believe central banks will cut rates, markets may rise. This is because interest rates influence how money flows through the financial system. Higher interest rates often make safer assets more attractive. Lower interest rates push investors to search for higher returns in riskier investments. Because of this, central bank announcements can trigger immediate reactions across global markets and sometimes Those reactions happen even before the central bank actually changes interest rates. Why central banks are so careful? Because interest rates influence so many parts of the economy. Central banks must be extremely careful with their decisions. Raising interest rates too quickly can slow the economy too much. Lowering rates too aggressively can fuel inflation or create financial bubbles. Every decision requires balancing risks. Central banks analyze large amounts of economic data before making policy decisions. They monitor inflation levels, employment data, consumer spending, and financial stability indicators. Their goal is not to control every aspect of the economy, but to maintain a balance that supports long-term stability. Even so, monetary policy is not perfect. Sometimes central banks act too late. Sometimes they tighten too much. And sometimes economic conditions change faster than expected. Because of this, central banking remains one of the most complex responsibilities in modern economic systems. Why understanding this matters, many people interact with the financial system every day without understanding how it works. They borrow money, they invest money, they save money, but few understand the forces shaping those financial conditions. Understanding how central banks influence interest rates can help individuals make more informed financial decisions. It provides context for changes in mortgage costs, investment markets, and economic cycles, and that knowledge becomes especially valuable during periods of economic uncertainty. Conclusion: central banks play a powerful role in shaping modern economies. Through their control of interest rates and monetary policy, they influence borrowing, investment, inflation, and economic stability. While these decisions may seem distant from everyday life, their effects are felt throughout the entire financial system. Understanding how central banks operate does not eliminate economic uncertainty, but it helps explain why markets move, why borrowing costs change, and why economic cycles occur. And once you begin to understand these mechanisms, the financial system becomes far less mysterious.